Hello, everyone, and welcome to our discussion on building your M&A team in the current financial landscape. I'm Elise Rogers, VP of Marketing for FPTransitions, and I'm thrilled to introduce this informative discussion. First, I want to briefly position our expertise. This panel will focus primarily on what you want the most: quality content and our expert opinions. At FPTransitions, we are celebrating 25 years of specialized consulting for wealth managers. We have grown to a team of over 60 highly credentialed appraisers, analysts, attorneys, and consultants. We provide advice and expertise to independent advisors that are committed to sustainability and value realization. Our mission is to help independent advisors identify, build, and realize value while promoting long-term sustainable growth. Today, we are joined by Oak Street Funding, and we will discuss the nuances of building your M&A team. Having worked with Oak Street on many deals, we have valuable insights to share with you. Before we begin, I have a few housekeeping items. This webinar will be available on demand. You can revisit this content at any time. We also have several free resources at the bottom of the screen. Be sure to check them out. Also, if you wouldn't mind completing the survey at the end, this will help us improve future discussions. Now, let me introduce our panel. First, our CFO, Eric Leeper. He's a CFA charter holder, and he'll moderate this discussion. As a seasoned expert in the financial services industry, he has extensive experience with mergers and acquisitions. He not only serves as our CFO, but also leads our consulting team. Eric has helped over 500 independent advisory firms in compensation design and equity structures, building sustainable and enduring businesses. His insights into market trends and strategic acquisitions are invaluable. Next, I'll introduce James Fisher. James is our VP of Mergers and Acquisitions and a legal expert specializing in the financial advisory sector. His expertise in structuring deals and navigating the complexities of the legal landscape, he'll provide us a comprehensive understanding of the current market. Our guests today from Oak Street Funding are Susie McEuen and Alicia Chandler. Susie and Alicia have been fantastic partners over the years, helping our mutual clients navigate the intricacies of financing and growth. Their perspective on the financing landscape is crucial for any advisor considering an acquisition. Today, we're going to dive deep into the world of mergers and acquisitions, exploring what has changed in the industry, what remains the same, and what we can look forward into the future. As a hot topic for many advisors looking to grow in acquisitions and plan their own succession, I'm delighted to present this to you. Without further ado, let's jump in. Eric, take it away.
Well, thanks, Elise, for the introduction. We're so glad to have Susie and Alicia from Oak Street Funding, who have been great partners to us, serving our mutual client base over the years. And we're really excited to talk about mergers, acquisitions, financing, what's changed in the industry, what we see ahead of us, and maybe some of the things that have stayed the same. You know, obviously this is a really hot topic. Many advisors are really interested in how to purchase other practices as a source of growth, but also advisors are looking ahead to what their own plans are. So with that, I guess we'll just jump right into it. James, what are we seeing that's really changed in the industry over the last 12 to 18 months?
Yeah, a lot of trends. I think first and foremost, I always get asked this question of, what's demand look like right now? And unequivocally, there's no sign of the demand slowing down. We appear to be in a very robust M&A marketplace right now. In terms of trends, I am seeing buyers be a bit more strategic about the opportunities that they are pursuing. They're not out there just pursuing or acquiring opportunities just to acquire them. We saw a little bit of that a few years back. So I think we've softened that a bit. And I think that likely has to do with the cost of capital, which we'll talk a bit more about today. But I think firms are having to be a bit more strategic in how they deploy the capital that they have. Again, we're still seeing, in terms of demand, 65 plus opportunity, or 65 inquiries for every opportunity we have. And some of those opportunities are pushing 100 plus inquiries. Specifically from a buyer's perspective, I think that demand is being driven by expansion into new markets, but also the need for talent and sometimes the expansion into new client service offerings. Maybe there's a niche that a firm has that is interesting for a firm, or maybe they have a large concentration of clients in Fortune 500 companies or governments that a acquiring firm finds interesting, and that's a foot in the door for them for those opportunities. And just real quickly, from the seller's perspective, I think the demand is being driven by firms seeking partnership opportunities. And I use that term specifically, which we will probably get into a bit more as we continue the conversation here. But the partnership opportunities that they're looking for tend to solve internal succession challenges that firms may have. They could also solve kind of internal growth constraints. Maybe they're looking to add value to clients and also to benefit from the infrastructure, inclusive of technologies, that some of these larger partner firms have built. Some of the other kind of trends that I have seen is the deployment of minority investment partnership opportunities. We've seen an uptick in firms that are interested in those minority opportunities over the last year or so. Also, the creative ability to deploy different deal structures. One thing that has specifically increased is the deployment of equity, and that the equity is being deployed not just as an incentive for the principals, but also for key employees in the organization that actually might not have equity in the firm that is being acquired. So, kind of a 30,000 foot view. Those are the trends that I'm seeing, Eric.
Yeah, definitely. And I wouldn't describe any of those as new trends per se, but I think the importance of those factors is definitely coming to the forefront. Specifically, I want to focus in on talent for a second here. We are seeing, as you mentioned, firms entering the M&A market from the buyer perspective, looking to actually not just acquire, what would historically be called like a book of business, but they're actually looking to bring on the entire team. So what they're underwriting to are teams that have strong internal advisor teams that can ride along with the transaction and sometimes be incentivized. In fact, all the time be incentivized to help assist with that transaction. For Oak Street, I'm curious, how do you evaluate that from an underwriting perspective? How do you perceive like the strength of the team, and how does that impact how you approach a credit opportunity?
Jump in there, sure. Yeah. So, thank you, Eric, and I appreciate the insight too, James, on the update of the information on the trends, because I had to agree with you 100% on what we're seeing is the same thing. And so when we do get situations where they're going to bring on the team, and it's really looking at the cash flow of the seller integrated in with the buyer's cash flow. And so hopefully, we walk through with the potential buyer, what are the duplicates as far as talent that they're going to bring on, because if the cash flow is not going to work to cover what we need as far as paying the down payment to the seller, it's going to be obviously going to be problematic. Unfortunately, situations, these larger firms that have employees, that may be a duplication of efforts, a COO or CFO, that's something that's got to be figured out in the beginning. So bottom line is really taking a full look at what the cash flow is going to look like with the seller's book or business integrated with the buyer's book, and making sure cash flows to cover the debt service on the bank note, and obviously there's probably going to be a seller note.
James, just sort of kind of pulling this thread a little bit. One of the other trends, I'm going to call it, that we had started seeing become more prevalent over the last several years is the timeline for the seller in the transaction, what we now call sell and stay. How important is that tail in the transaction from a point of view of structuring?
Extremely important. Historically, when people talk about an acquisition, they think about the consideration being paid for the business. And that is a very important component of a transaction, but you can't lose sight of the growth consideration that is being paid, or a tail, if you will. The other component that you can't lose sight of when you're focusing on a transaction and the right partnership is what the ongoing relationship is going to look like. When we're talking about a sell and stay, this isn't what I traditionally categorize as a traditional sale, where the advisor or the team is selling their business with the intent of retiring shortly thereafter. This is a long, what is hoped to be a long tenured relationship between the two firms. So there's a lot more that goes into the analysis when you're looking at that type of relationship. So again, you can't focus on the core consideration being paid. You've got to focus on, the compensation and the consideration that's being paid for the shared growth in both of those businesses going forward. So very important to your point, Eric.
Yeah, and I think what we're getting to here is the idea, specifically the word sale, has become quite a bit of a misnomer in a lot of the work that we do. Sale, it was always viewed as somewhat pejorative, and I think for a good reason. Sale means, hey, I'm selling my business and I'm walking away. And what we found is that most of the M&A transactions that we're working on right now aren't pure sales, because of the inclusion of equity, which is being carried over into the acquiring partner firm, and the presence of long-term employment agreements and other strategic roles that traditionally the sell side is now taking in the acquiring firm, means that it's really not really a sale at all. It's really more of a partnership. I'm curious, from the Oak Street perspective, what are you guys seeing that is maybe new in the space, or causes people to kind of rethink the process?
I'll
Go ahead.
Okay, I'll jump in there. We are seeing a lot of they want to stay, and it seems as though these older advisors are looking at, they don't want to have to manage the business any longer.
Yeah.
They're taking that next step that, I want to focus on my clients. It's that next step in their journey towards the succession planning, the retirement. And we actually like those kind of transactions because the continuity of it, the clients stick, and usually it's a situation where they're coming together because they've known each other for a long time. That's the ones that I've seen a lot recently of. And it seems as though the process, probably from your side as well as our side, to get to the finish line on closing, funding, goes a lot smoother when the two parties together have same philosophies. They know each other in the community, same type of client base, and it's a younger advisor that's ready to take on the responsibilities of the back office management, and that particular seller just really wants to slow down a little bit.
Yeah, and for us, it's perfect alignment, right? Because now you have a seller that is aligned with the buyer / borrower. They're rowing in the same direction. You have, a lot of these, as we were talking, they have that equity component, and the seller is incentivized to continue to produce, continue to retain those clients and grow that client base. And then they don't have to worry about the back office. And so, that it's really good alignment, and it obviously is good for everyone when the earnouts are as big as possible and the firm's producing even more cash flow than they thought. So yeah, we love to see that.
Yeah, and we also see, like, even on the websites, the acquirer that is bringing on the seller, they include that person still, like even their branding, their name, to really make it transparent as far as smooth transition for even the customer base. So we get really excited about those type of transactions.
And
more.
And I think for you guys, the one thing that when we have these situations, the big focus is on that relationship and if they're aligned going forward. And when we have partners like you guys that have those in-depth conversations with the buyer and seller on the front end, that gives us a lot of comfort, because obviously execution risk and post-close, how they're going to mash together, their philosophies moving forward on investments and treating clients and the staff. That's a huge piece of it. And that's that intangible that, it's really hard to to pin down. So it really helps when we have people like you guys assisting on the front end.
Yeah, and
But
if I could add here, I mean, we use the term partnership with the clients that we work with very intentionally here at FP. I mean, that's what we're seeking to build. You know, if someone comes to us and their sole concern is the cash, I mean, certainly we can help with that, but we get excited about firms that come to us and are focused on finding a true partner out there in the marketplace that views the world through the same lens that they do and is really concerned about kind of the three stakeholder groups on their side, which is, you know, the partners of their organization, or the shareholders, the team that they have built, and the employees that they have, and their clients. You know, if they're focused on those three things, that's what we get excited about, because that is our North Star in trying to find what we consider a true partner for their organization. And if you find that true partnership, each one of those stakeholder groups is going to have a benefit from whatever the transaction looks like. And that's what true partnership means for us. This can't be a fact pattern where, you know, you satisfy 2 out of 3 of those stakeholder groups and you do the deal anyway. That should be a non-starter if you're focused on finding a true partner.
Yeah, and I think that speaks, you know, very well to the amount of preparation that we do with specifically starting with the sell side of that transaction. James, what are the types of conversations that you're having that help people prepare for the process ahead?
Yeah, that's a really good question. And I think every firm's a little different in terms of the preparation that they need. There are many clients that I work with that have worked with FP for 10 years and have started, you know, very early on in some of our coaching programs, or started with us by bringing some of their, you know, rising stars into the organization and into equity in the business. And that is helpful. To have that background in color and those coaching moments along the way. And we're here to kind of complete the life cycle. You know, for every advisor that we work with, you know, they've got to do some form of transition. You know, it's either internal or external. We're there to help with both. My focus, of course, is external. So what I'm talking about in terms of prepping them for that external sale is, you know, just getting to understand the principles of the organization, understand the team, and really focusing in on what they've built and what the ideal partner looks like for them. I mean, I can certainly share my thoughts, but we're the navigators. They're the captains. They've got to really give us, you know, what their viewpoint is, and we can certainly navigate around that. But it's just a really in-depth conversation about what excites them. And some of this isn't necessarily business focused. Some of this is, you know, what do they enjoy doing outside of the 9-to-5 job, if that's what it is, or just the business environment, because we want to find a partner that is not only focused on the same type of business, but is culturally aligned. Meaning if they spend a lot of their time working with nonprofits or giving back to the community, we need to find a partner that also has that same kind of ethos and it is built the same way and puts importance on that in their organization. So again, this is a very in-depth conversation about what makes them tick and what makes their organization tick.
And Susie and Alicia, you obviously work predominantly with the borrower from an underwriting perspective. What kind of preparation do you do with them as they think about doing transaction? Are you engaging them really early on in the process, or like what's a perfect engagement look like for you all in terms of preparation?
One thing I have to say, you guys do a great job of contacting us in the beginning. Your salespeople, consultants will reach out to me. It could be in the very beginning stages where one of your clients they're interested in buying a book of business and they want to know what to do in order to get prepared. And to James's point, some of these conversation takes on for years. I've been here for 7 years, and it's interesting. I had a person call me that said I talked to them 5 years ago. And obviously we have all that information in our system because we have a CRM system, and I was able to go back to see what our conversations are. But it's best, and I think you will feel the same way. And I think that's why we have a good relationship with FPTransitions. We think very similar as far as client focus and doing the right thing for our clients. But having those conversations up front to prepare them financially and mentally for the next step, especially in a situation where they've never done this before. So they have lots of questions, and what they don't know, they don't know. And I get those questions like, well, I don't know what I don't know. Can you tell me? And so like you, I'm trying to find out what's important to them. Why are they wanting to buy? Have they ever done this before? What's their financial picture look like? What does their book look like? The demographics of that book. What are they interested in? Are they trying to diversify revenue streams? And that seems to be becoming a more, you know, a way for inorganic growth, that, you know, they're looking at CPA firms or tax accounting firms to diversify, to take that next leap. So we look at the whole big picture, and we kind of, I want to say, move in steps based on where they are in their journey of buying. If they found something, and you guys have approached us with possible potential need for capital, then we take it the next step further, where we're diving deeper, getting the financial information to see if we're going to be able to assist them with, obviously, with the down payment financing. Alicia, you got anything you want to add?
You know, I think to speak to James' point and what you were saying, Susie, is the earlier the better, right? Before they've started that whole process of actually entering into an LOI with a partner, it's ideal for us to have that relationship established, so we all have the same expectations moving forward, and we can explain that to them so that they can in turn engage the seller in those same conversations and expectations moving forward. So there's no getting to the finish line and then having to backtrack. So
No surprises.
No
That's the goal.
surprises.
Yeah, I like those surprises.
Yeah,
and in terms of, if I could, Eric, just continue here a bit, in
Please.
terms of the preparation, I mean, you all were talking about the why. The why is hugely important. You know, occasionally I'll run into someone who comes to us with even a signed LOI in hand, and you start peeling back the onion and asking why this transaction, why this buyer, why this seller, and they don't have a good answer. You know, the worst answer I've gotten from a acquiring firm is because everyone else is doing M&A, so we feel like we need to as well.
It's classic FOMO.
Not a good answer.
It's FOMO, James, fear of missing out. And the reality is you know, I'm sure Susan and Alicia have similar stories, but we find people who are the proverbial dog that caught the car.
Yeah.
You know, they didn't know why they were chasing it, and then they got it. Okay, what do I do with it now? And they really have a fear of missing out on an opportunity, because it's very hard to do a transaction. And the reality is that the reason why it's so difficult to purchase a practice right now is because of the alignment that we have to create between both sides of the transaction. So if you lead in the process with something that doesn't focus on alignment, you end up with adverse outcomes down the road. And one of those outcomes can be what you described, Susie, is specifically, hey, have you considered what the financing looks like? Do you have a relationship with a lender who knows the industry, who knows how these transactions are put together, and can inform you about what is a realistic deal structure? We do see an unfortunate number of people who sign term sheets and don't have a really good grasp of what it takes to actually follow through with those financial commitments.
Or
and
how
so
they're going to do it.
Yeah,
I mean,
exactly.
You know, we have people that come to us and say, "Oh, we're just going to get bank financing." Okay, well, from who? Well, we haven't gone down that path yet. But you're telling me you want to consummate this transaction in 30 days. If you haven't gone down that path, you're, you know, 60 to maybe 120 days ahead of where you should be in terms of getting this deal closed. Not that it always takes that long, but I mean, to you all's point, it's never too early to contact you all and to have that conversation about what your strategy is and the type of opportunity that you're seeking to onboard into your organization if you're an acquiring firm.
Absolutely.
Yeah.
If you've never done financing before, this is not buying a car, it's not buying a house.
Correct.
And so we have to not only look at their financial situation, we have to look at the seller's financial situation. We
Yeah.
got to do a lot of due diligence to make sure there's not something out there that is, I call a skeleton in the closet. And so it does kind of scare some of the new people that have never done this before, but I try to carefully craft that so it doesn't seem overwhelming and take it step by step. But they really need to, I always say this to potential buyers that are, you know, they think that's a really sexy thing to do is go out and buy a book of business and they've never done it before. I said, you got to align yourself with professionals. That is consultants like FPTransitions. They do the things that we don't do, the valuations, you know, the business documents, the structure, continuity agreements. And then there's us that provide the capital, and we work together as a team and bring your accountant in, so we can look at everything holistically.
Yeah, the other thing, I think sometimes if you have these folks that are not prepared, I don't think they really have an understanding of how much time and effort and energy it takes for a transition or a transaction, and the time that they're going to have to take away from operating their existing entity,
Yes.
their firm. And so sometimes they lose focus. And so I think, again, it's just the earlier the better, and they can understand the amount of time and effort. And if they have that time and effort, if they have just people on their staff to assist them, or what it's going to take to get to that step where they can actually be ready to purchase without taking focus off the most important thing, which is their own business in the first place.
I panic when they say, I have a signed LOI.
You and me both.
Yeah, that-
I'm like, uh-oh.
we've talked a lot about this concept called deal fatigue, and there it takes different forms. You know, some people say time is the biggest deal killer, and that we see that time and time again. And what that comes from is really a lack of momentum in the transaction. If you really want to have a successful deal between a buyer and a seller, or two partners, depending on how you want to categorize the transaction, you need to build momentum, and that means you can't get bogged down by administrative things that should have been dealt with prior to the transaction. So things like getting your books and records in order, understanding the due diligence process, and keep in mind there are two due diligence processes when you're involving a finance source. There's due diligence that the buyer is doing on the seller. There's also due diligence that the bank is doing on the buyer, right? So understanding sort of those timelines, how much time it takes, and making sure that we're getting those tasks done early on so they don't creep into other vital time periods in the transaction and cause us to lose momentum. So that's sort of a public service announcement I think we're both saying, you know, with the loudest megaphone that we can, which is prepare ahead of time, create your professional team, which is consultants, CPAs, financing sources, understand what their respective timelines are. By the way, it's very hard to get CPAs on the phone before, you know, April 15th every year. So that's a consideration we have to work around. Understand the bank's underwriting timeline. What is a typical, what's the fastest you could do a loan right now, Susie and Alicia? I mean, if you started from zero, how much time would we need to put it together?
Well, if we've done some things at the end of the year where it was time is the essence and like in 2 weeks.
Okay, let's start ideal. Let's talk about ideal.
But realistically, I mean, you know, we put the Superman cape on and, you know, can do it in a couple, but that's not the normal situation. Every deal is different. Every transaction is not cookie cutter, but I would say on average, depending on the loan size, you know, we can look at probably less than 60 days, but also, you know, I can tell pretty much right up front if somebody's going to be organized or not. So when I'm talking through and getting to know them over the phone, you know, I may stretch that timeline out, but I tell them why and how you can get there. And if they've got someone that can get the information to us, and besides the CEO that's trying to do everything in the company, then I'd rather work with that person. So I always suggest that. But you know, we've done 45 to 60 days. And once we get a term sheet signed from our potential borrower, then it's all hands on deck here to get them to the closing table. in 30 days. And sometimes we're twiddling our thumbs waiting for the buy sell to get finalized because they're going back and forth, back and forth. And I'm sure you guys know that because we work with you on many transactions.
Yeah, and I would say that just to keep in mind, this is another note for all the buyers who might be tuning into this webinar. Lack of organization is something that sellers absolutely do not tolerate. Someone who has built their practice for 40 plus years and they have one chance to do this right, they are looking for someone who is on their game, who is organized, who knows how to get these things done. So this is why we encourage people who are interested in the M&A space, reach out to your professional team. That's your Oak Streets, your FPs, and understand what that whole timeline looks like and get yourself organized, because we've had a number of deals where the seller has lost confidence because the process is taking too long, and it's totally preventable by having, plan an extra week in the transaction, get your stuff organized, and then execute, build that momentum, and go get it done. I can't stress that enough.
It's very uncomfortable and unfortunate for us when we have a borrower that's kind of jumped the gun, and then the seller's ready to go and we're still waiting on organizational documents or updated financials or things from the borrower / buyer. It just puts us in an uncomfortable situation, and it really stretches it out, and the seller does get, I think, just more uncomfortable, gets the deal fatigue, and really questions if that's the right transaction for them. We've seen that quite often, unfortunately.
It is unfortunate.
A lot of the loans that we do, and I'm sure you see it too, they're not cookie cutter. Every transaction is different. So we walk into the opportunity we want to hear from the buyer, our borrower, what they want this to look like. And when we're asking, but what is the seller expecting? What are their goals as far as, from a tax perspective, so we can make sure that we can create the structure that's going to align and work for all the parties involved, to include us as far as a bank. We're not an SBA lender, we're a conventional lender. So the collateral for the loan is the revenue stream. We don't involve the personal assets. And so we are going to dive really deep into the demographic information, the revenue stream. And to your point, organization is going to be critical, because we're going to ask for reports to validate and verify what that collateral is going to be. And it's the first time buyer, again, we walk really carefully through that process with them and explain our journey from start to finish.
I love that. I want to pivot a little bit here to James and just talk about what are the most common deal structures that we're seeing in the marketplace. What is the composition of the financing and the other different incentive structures that we commonly see these days?
Yeah, I mean, to just kind of echo some of the thoughts that have been said, it is very dependent upon each specific transaction, and a lot of it depends on what the firms are looking to get out of it. A traditional sale is probably going to look like a traditional transaction, in that you're going to have some cash up front, maybe upwards of 50%, and then the rest on a seller financed note, maybe payable over 3 to 5 years. So very conventional in its look and feel. A sell and stay transaction, is going to be something that's a bit more complex. It's going to have a down payment, but it's going to have other forms of consideration, just given the nature and the tenure between the parties going forward. And that's where I think the complexity, but yet the flexibility also comes in to structure a transaction that's exciting for both parties. How you come up with the cash, of course, bank financing is a big component of that for a lot of folks in the marketplace. If they're not using bank financing, they probably have either a private equity partner or maybe just a war chest of cash that they use to deploy for purposes of acquisitions. But there's a lot of diversity in the deal structures that I'm seeing right now. I mean, we talked about equity at the outset of this conversation, as being kind of a currency that people are using, and it's a very attractive currency. You know, a lot of these firms that are in quote unquote growth mode, you know, they can demonstrate to a seller that while the seller may have been growing at, you know, 7 or 10% a year, they're growing at 35-40% a year. So you get the opportunity to swap your equity and to get on the proverbial elevator ride that these firms are experiencing. With that, of course, you have to back up and take a deeper dive into that organization to make sure it's the right partnership. So going back to the conversation we were having about, you know, synergies amongst folks, a sell and stay is a much more complex process from a synergistic standpoint than a traditional sale. Most folks who are going down that traditional sale path, yes, they care about who they're selling their business to, and they care about the client relationships and where those relationships are ultimately going to end up. But it's not as an in-depth conversation because you don't necessarily have that equity pull. So, you know, can I talk about specific deal terms that I'm seeing? Yes, but I think the message I want people to receive is that there's a lot of diversity out there, and we can find a partner firm for an organization that provides you with a deal structure that's exciting, irrespective really of what that deal structure is in your mind.
Susie and Alicia, I wonder if you have any just sort of any general comments around the topic of structure. Are there structures that you all commonly see, or maybe talk about how you would underwrite some of the most common structures in the industry, and what should borrowers know about how you approach those different credit opportunities?
Sure, absolutely. It's definitely an alignment where, you know, it's their equity in their book of business or their RIA that is acquiring the seller's book of business, those assets. And it's an alignment where, depending on, you know, if it's a tuck-in type situation where they're tucking in a smaller book of business, and what we want to make sure is that we don't have too much leverage as far as stretching the down payment too high. We look at both the fact, you know, what does the seller want out of it? How long is the seller going to stay in it? I always get a little nervous if they say, I want the remaining cash in 12 months and I'm gone, and they really haven't been involved. So we know that's going to add more risk for retention on those clients. So I do ask a lot of questions there. But we're still seeing some of the common splits where it's like 70% down.
Yeah.
We provide that 70% down, and then the 30% remaining is a traditional promissory note subordinated to us being the bank. But we also, I've got one borrower right now that they just brought on a gentleman that is in his probably early 60s, it has a book of business, and he exchanged the assets for ownership in this RIA. It was a complete exchange. So we're seeing different transactions like that. But again, every deal is a little bit different, especially if they want some type of earnout of some sort. And it could be based on what the book of business looks like, what is making up the demographics of it, whether it's an earnout or a promissory note. But the key is going to be this, is that the combination seller note and bank note there's got to be a sufficient cash flow to cover both, and especially do a stress test. We have our borrowers do performas. What are you going to look like with post-closing as far as overhead expenses with that revenue, modest growth? We do a stress test to see what if there's a hiccup in the market, to make sure that we don't put them in a situation that's going to put them in a very awkward situation where we're, you know, calling covenants or anything like that.
I want to pull that thread a bit, because I think one thing that gives sellers comfort is knowing that Oak Street sitting on the other side of the transaction and doing the analysis that they do from the buyer's perspective. You know, I know they can't rely on it, but I've had a number of conversations where they take comfort knowing that there's a second set of eyes, including their own, looking at all of this and, you know, stress testing it, if you will. So, you know, if you're out there and you're considering whether, you know, you're going to go at it alone or you're going to deploy bank financing, you know, there is a benefit to the bank financing in the eyes of a seller from that perspective.
Yeah, and I
Yeah.
think that's very important. You know, I know our sales team and our underwriting team spend a significant amount of time talking to the buyer / borrower about those covenants and making sure they understand how they're going to be calculated moving forward, and, you know, any of those risks that are associated with how quickly the revenue is going to, you know, move over, if they have to repaper or do anything like that. And so again, it is kind of an all hands conversation on the importance of that. And we are not going to be setting those covenants to a level and being so tight that there's just, you know, that slight chance that something could happen. We want to make sure that we're giving, that we're being conservative and giving plenty of room to make sure that they can stay in compliance.
Alicia, I'm glad you said that, because we do try to accommodate adverse outcomes specifically related to things like client transfer. Almost every deal that we put together does have a provision to adjust the purchase price if the clients don't transition over, right? And that could be for a lot of different reasons. That could be just because the transition wasn't handled well. It could have been done from a misrepresentation. It could have been done from a health issue during the transition. There are lots of ways that can happen. But what we don't want to do is we don't want to imperil the creditworthiness of the transaction, right? We do want to make sure that the bank is protected, and that the seller is realistic with respect to, hey, if I can't actually transition these assets, the deal is probably not worth as much as we thought it was. So that is something that we look at very carefully, and we do work with Oak Street to make sure that our deal documentation is protecting all parties to the transaction, making sure it's fair and reasonable all around. I want to touch on one question that we get very commonly that we are always hesitant to answer, because we are not the lender. How do you prepare borrowers for the interest rate environment? I mean, we just get constant questions about it, and understanding that we're not yield curve experts, but what do you tell people about the current rate environment when they ask?
We talk about that all day, every day.
I talk about it all the time, and it's amazing, especially during 2022 when the interest rates were going up. I think I was so exhausted every single day at the end of the day, talking about why the rates, and it depends on, I hate to use it, but the age of the person that I'm talking to, because if they've been through some of the different market volatility situations that we've experienced here recently over the course of the last 25 years, they get it. But I think we are a little bit over that hump a little bit now, because everyone's kind of getting used to the fact that the rates are where they are. But, you know, there was a slowdown, and I think you probably experienced the same thing, because we refer to you, you refer to us, and but it has changed. A lot of our borrowers right now, we use our treasury index for our loans plus a spread. And where we are today, most of our borrowers look at it like that. We offer 10-year fully amortizing loans. And if they get a 10-year fully amortizing loans, I don't have to say to them, I'm like, you probably don't even want to get a 10-year fixed rate. But everybody is leaning towards that short-term fixed rate, going to variable, because we all anticipate that rates are going to come down a little bit. I don't think they're probably going to get anywhere where we were before, but they are getting used to it. So I don't get as many questions about it that it's sticker shocking when I say rates are in that 9% range, like I have in, like, I would say a year and a half ago.
Yeah, and we would echo a lot of that. It used to be, you know, pre-COVID, everyone was looking for 10-year fixed, and what we're seeing is people are taking a much more creative view of the interest rate environment and coming up with structures that work. I mean, never bet against the ingenuity of this group of acquirers out there. They always find a way to make it work, and the reason for that is because if a transaction is structured successfully, there are so many benefits across the board. And that's what we help people try to figure out is, are those benefits worth it? And is now a good time to explore this avenue?
Right, it's a cost of doing business, just as everything else is, and
Mhm.
if it's a great transaction and it's gonna add a lot to the bottom line, that interest rate and the spread at the end of the day, it's just gonna be a little portion of it, but you're still gonna make, obviously make a lot more money. It's a great transaction, so you just gotta keep it all in perspective with the big picture.
We
Yep.
do see a lot of interesting structures on the seller note side, as far as sometimes charging an interest rate, sometimes there's a delay. It depends on a delay for payment,
Mhm.
sometimes interest only. We do get a lot of questions where the buyer is asking, what should the seller note look like? And I'm really careful when I respond to that, because I don't want to overpromise or anything. They gotta really have that communication with the seller to understand what their
And
goals
us. Yeah, we do a lot of that interfacing with respect to
consulting.
the structure. Yeah.
So I'm really careful when it comes down to that seller note, but I've seen some really interesting structures recently. I mean, interest rates are higher than our bank rate. I just saw like yesterday. And I was like, wow.
Hmm.
So you just never know.
So throughout the conversation today, I think we've kind of sprinkled in tidbits here, but I want to try to bring this to a summary point, and we'll start with James. James, in your view, what makes a great transaction with respect to M&A? You can answer that question however you want, but what are the things that you're advising clients on and thinking about when you say, wow, this is an ideal situation?
Well, I mean, I'll probably sound like a broken record from many of the webinars we've done in the past, but it all comes down to fit. And fit for one organization, it is differentiated, meaning if it's fit for me, it may not be fit for you, but it's really focusing on what that means for your organization and what the ideal opportunities are. We've talked a bit about today, the firm catching the proverbial car. We've talked about, people acquiring just to acquire, and that isn't what you should be doing. You should be focused strategically on firms that are, if you're an acquirer, firms that are additive to your organization, focusing on, talent or blind spots or niches that may be great bolt-ons or tuck-ins, whatever term you want to use to your organization. From a seller perspective, you really need to be focused on what a true partnership means for you. Because again, it's like fit, that doesn't have the same meaning for everyone. We spend a lot of time consulting around kind of those themes. FP at its core, our North Star, we're a consulting firm. So we enjoy doing that, and we enjoy making sure that the opportunities and the partnerships that we're putting together are long lasting.
That's great. Susie, Alicia, what's a perfect transaction look like from you, from your perspective?
Well, I know what mine is. I do like those buyers that have done this before, and where possibly if a book of business has to be repapered, that the seller has done this before and their clients have moved. But they also financially, they're working with a firm, they're working with you. And you guys have started working with them as far as alignment, and the beginning stages is really critical. We can't, like Alicia said, we can't start the conversation too soon. Financials in order. Doesn't necessarily mean they have to have their taxes not on extension, because most people file extensions, but they really need to make sure that they're working with an accounting firm that's providing quality type financial statements, and have that information available, and prepare the seller that we're going to be needing that information as well. So that's probably my North Star perfect type situation.
I echo that. I think what we ideally like to see is people that are well prepared, and they understand the why. They've had that conversation with you all and the seller to say, look, this is why we're coming together. A lot of it's the intangibles, right? It's not something that you're necessarily going to be able to put onto the financial statement, but it's really about that relationship, the fit. So we have, lessened that transaction risk. And then it's just, again, making sure that everyone understands, our documentation, our process, what we want to see. So there's no surprises going forward.
Full transparency.
Full transparency.
Here, here.
Well, I don't think we can emphasize that point any more than we did on this discussion today. You heard it here. You need to start early, assemble your team of professionals, and think through all of the different outcomes. And James, you mentioned the different stakeholders at the table. There's the client, the staff, and the owners that are engaging in this transaction. So thinking through all of those outcomes, preparing well in advance of your anticipated close date, and building momentum to execute. I mean, those are the themes that we think make. I think we're all agreeing that those are going to make people successful, whether you're on the buy side or the sell side. So I think we'll wrap there. I really want to thank again Susie and Alicia, and also James, for joining us today. Obviously, many more discussions to come on this topic. It's an ever evolving and dynamic area of the industry, and we look forward to continue to work with you to help our clients, our mutual clients, bring these transactions to a close. Thank you.
Thank you for having us.
Yeah, and thank you for your partnership. It's always a pleasure working with all of you.
Yeah, and that's mutual, of course.